In 2005, I made a bet that everyone thought was insane. I went to the biggest banks on Wall Street and asked them to create a financial instrument that would allow me to short the housing market. They laughed at me. They thought I was out of my mind. Housing prices had been going up for decades. Everyone knew that real estate was the safest investment in America. And here I was, some guy running a small hedge fund in California, telling them that the entire system was about to collapse. I remember the meetings vividly. These bankers in their expensive suits, looking at me like I was a crazy person, they took my money. Of course, they were happy to sell me insurance on something they thought would never happen. They thought they were taking candy from a baby. For 2 years, I watched my portfolio bleed. My investors were furious. They demanded their money back. They threatened to sue me. They called me every name in the book. I had people who trusted me with their life savings telling me I had destroyed their futures. And every single day, I questioned myself. Maybe I was wrong. Maybe the housing market really was different. Maybe prices really could go up forever. But I kept looking at the data, and the data told me that the entire financial system was built on a foundation of sand. Mortgages being given to people who could never pay them back. Securities rated AAA that were actually worthless. An entire industry operating on the assumption that housing prices would never fall. When the crash finally came in 2008, I made a fortune, hundreds of millions of dollars. But I didn't feel victorious. I felt sick, because I knew what that crash meant for ordinary people. Millions of families losing their homes, retirement accounts wiped out. A generation of young people entering the workforce during the worst economic crisis since the Great Depression. I tell you this story not to brag. I tell you this because I want you to understand something fundamental about how I think about investing. I don't try to predict what will go up. I try to identify what can go wrong. I look for the risks that everyone else is ignoring. I build portfolios designed to survive the worst-case scenario, and right now. In 2026, I believe we're heading into a period of significant financial stress. I am not predicting an exact date. I am not telling you the market will crash next month or next year. But I am telling you that the conditions for a major dislocation are building. And if you are not prepared, you could lose a substantial portion of your wealth. So today, I am going to share exactly how I would build a crash-proof portfolio. Not a portfolio designed to maximize returns in good times. A portfolio designed to survive and even thrive when everything else is falling apart. Let me start by explaining what I mean by crash-proof, because I think a lot of people have the wrong idea. A crash-proof portfolio is not a portfolio that never goes down. That is impossible. Any portfolio with exposure to financial markets will experience volatility. What I mean by crash-proof is a portfolio that can withstand a severe market dislocation without permanent impairment of capital. A portfolio that gives you the financial and psychological ability to hold through the storm and come out the other side intact. The key principle behind crash-proof investing is asymmetry. You want investments where the downside is limited but the upside is substantial. You want to avoid situations where you can lose everything. And you want to position yourself to benefit when others are forced to sell. Let me break this down into 5 core components that I would include in any crash-proof portfolio. The first component, and this is probably the most important, is cash and short-term treasuries. I know this sounds boring. I know cash doesn't earn much. I know that holding cash feels like you are missing out when the market is going up. But cash is the ultimate crash-proof asset. It doesn't go down when stocks crash. It doesn't default when companies go bankrupt. It gives you optionality when everyone else is desperate. I would hold at least 20 to 30% of a crash-proof portfolio in cash and short-term treasury bills, not long-term bonds. Short-term instruments with maturities of 1 year or less. This is your ammunition. This is what allows you to buy when everyone else is selling. Think about what happened in March of 2020. The market dropped over 30% in a matter of weeks. People were panicking. Prices for high-quality companies were cut in half. But most investors couldn't take advantage of those prices because they were fully invested. They had no cash to deploy. They were forced to watch the opportunity pass them by. Or worse, they were forced to sell at the bottom to meet margin calls or living expenses. The investors who made fortunes during that crash were the ones who had cash on hand. They were able to buy when blood was in the streets, and within 18 months, their purchases had doubled or tripled in value. I've studied every major market crash going back to the Great Depression. And in every single case, the investors who did best were the ones who had liquidity when everyone else was desperate. During the Depression, those with cash could buy stocks at single-digit price to earnings ratios during the 1974 crash. Cash-rich investors bought blue chips, yielding 10% or more. In 2002, after the tech bubble burst, cash allowed smart investors to buy great companies at once, in a generation prices. This pattern repeats because of how human psychology works during panics. People who are fully invested have no choice but to hold on and hope, or to sell at terrible prices to meet obligations. They're passive participants in the crash, watching helplessly as their wealth evaporates. But people with cash can be active participants. They can take advantage of the fear. They can be the buyer when everyone else is selling. Cash is not a wasted asset. Cash is a strategic reserve. It is insurance against the unknown. And in a world where the unknown seems to be getting more likely, that insurance is invaluable. No, I want to address a concern that people always raise about holding cash. What about inflation? Isn't cash losing purchasing power? Yes, in normal times, cash earns less than inflation, which means your real wealth is slowly eroding. But here's what most people miss. During crashes and deflationary events, cash becomes incredibly valuable. Prices of real assets fall. The purchasing power of your cash actually increases relative to the things you want to buy. And the optionality that cash provides, the ability to buy assets at distressed prices, more than compensates for the slow erosion during normal times. Think of it like insurance. You don't buy car insurance hoping your car will get wrecked. You buy it to protect against the downside scenario. Cash serves the same function in a portfolio. It is protection against the scenarios you hope don't happen but might. The second component of a crash-proof portfolio is high-quality value stocks. And I want to be very specific about what I mean by high quality. I am not talking about growth stocks trading at 50 times earnings because they might dominate some market in 10 years. I am talking about boring established companies with strong balance sheets, consistent profitability, and stocks trading below their intrinsic value. The characteristics I look for are straightforward. First, low-debt companies with minimal debt can survive recessions and credit crunches that destroy their leveraged competitors. When times get tough, debt becomes a death sentence. The companies that survive are the ones that don't have to worry about making interest payments when revenues are falling. Second, consistent free cash flow. I want companies that generate real cash, not accounting profits that exist only on paper. Free cash flow is what allows a company to pay dividends, buy back stock, invest in the business, and survive downturns. If a company isn't generating free cash flow, I am not interested. Third, low valuation multiples. I want to pay less than 10 times earnings for most of my stock holdings, ideally less than 8 times. When you buy cheap, you have a margin of safety. The stock can fall further, and you are still okay. When you buy expensive, any disappointment can result in catastrophic losses. Fourth, tangible assets. I prefer companies that own real things. Factories, land, inventory, equipment. These assets provide a floor on the stock price. Even in a worst-case scenario, the company can be liquidated for something. Compare this to a company whose value exists entirely in intellectual property or brand value assets that can evaporate overnight. Let me give you some examples of the types of companies I am talking about. These aren't recommendations, just illustrations of the characteristics I look for. Think about a company that manufactures basic industrial equipment. Boring, right? Nobody gets excited about valves and pumps, but that company might trade at 7 times earnings, have no debt, pay a 3% dividend, and own factories worth more than its entire market capitalization. That is the kind of company that survives crashes. Or consider a regional bank in a stable market, not a giant money center bank loaded with derivatives and complex financial instruments. A simple bank that takes deposits and makes loans, trading at 80% of book value, paying a 4% dividend, with a history of profitability going back decades. That is crash proof. The key is avoiding the popular stocks that everyone loves. During crashes, the stocks that fall the most are the ones that were most overvalued. The darlings, the momentum stocks, the companies trading at 30 or 40 times earnings, because everyone expects them to keep growing forever. When reality disappoints, those stocks can drop 70 or 80%. But the boring value stocks, the ones nobody pays attention to, they often hold up much better because there is no premium to deflate. I would allocate 30 to 40% of a crash proof portfolio to these high-quality value stocks spread across multiple sectors and geographies to diversify company-specific risk, not concentrated bets on a few positions. Broad exposure to cheap, profitable, conservatively financed businesses. The third component of a crash-proof portfolio is hard assets. I am talking about gold, silver, and exposure to real estate in specific situations. These are the assets that have historically held value during periods of financial stress and currency instability. Gold in particular deserves a meaningful allocation in any crash-proof portfolio. I would hold 5 to 15% in physical gold or gold-backed securities, not gold mining stocks, which are actually equity investments with their own set of risks. Physical gold or ETFs that hold physical gold. Gold serves several purposes in a crash-proof portfolio. First, it is a hedge against currency debasement when central banks print money to bail out the financial system, and they always do during crises. The value of paper currency tends to fall relative to gold. This has been true throughout history. Every fiat currency that has ever existed has eventually been debased. Gold is the timeless alternative. Let me put this in historical perspective. In 1971, gold was priced at $35 per ounce. Today, it is over $2,000 per ounce. That is not because gold has become more useful or more valuable in any intrinsic sense. It is because the dollar has lost purchasing power through decades of money printing and inflation. 1 ounce of gold today buys roughly what 1 ounce of gold bought 50 years ago in terms of real goods and services. But $1 today buys a tiny fraction of what $1 bought 50 years ago. When you hold gold, you are opting out of the paper money system. You are holding an asset that central banks can't print more of. You are protecting yourself against the policies that governments inevitably pursue during financial crises, which is to create more money to paper over the problems. Second, gold tends to perform well during periods of extreme fear. When people lose confidence in the financial system, they flee to the ancient safe haven during the 2008 crisis. Gold was one of the few assets that held its value while everything else collapsed. The same pattern has repeated in every major crisis going back centuries. When the world gets scary, people want to hold something that has been recognized as valuable for thousands of years. I remember during the depths of the financial crisis, when it looked like the entire banking system might collapse, talking to other investors about what would happen if things really fell apart. The answer always came back to gold. It is the asset that works when nothing else does. It is the insurance policy against the unthinkable third. Gold provides geopolitical insurance. If you are worried about scenarios that most people consider unthinkable, things like major conflicts, currency crises, or breakdown of international trade, gold is the asset that has survived every such event throughout human history. It is the ultimate form of portable, universally recognized wealth. Now, I want to be clear. I am not a gold bug who thinks you should put everything into precious metals. Gold doesn't generate income. It doesn't compound over time. Like a good business, as a long-term investment in normal times, stocks have dramatically outperformed gold. But in a crash-proof portfolio, gold isn't meant to maximize returns. It is meant to provide insurance against tail risks. And for that purpose, it is invaluable. I would also consider holding some silver, perhaps 2 to 5% of the portfolio. Silver has many of the same characteristics as gold, but with more industrial demand, which can make it more volatile. Silver tends to outperform gold during periods of rising precious metals prices, but it also falls harder during downturns. It is a more aggressive version of the gold allocation. Real estate is trickier in a crash-proof portfolio. On one hand, real estate has historically been a good inflation hedge and a source of stable income. On the other hand, real estate is illiquid, and prices can collapse during financial crises, as we saw in 2008. If you do include real estate in a crash-proof portfolio, I would focus on properties with low leverage, stable tenants, and locations with strong fundamental demand. Agricultural land is particularly interesting because people always need to eat, regardless of what is happening in the financial markets. Before I move on to the fourth component, let me share a story that illustrates why these value stocks are so important. Back in 2001, after the dot-com bubble burst, I was analyzing a small auto parts company. The stock had been cut in half because investors were fleeing anything remotely connected to the economy. Everyone was worried about recession. But when I looked at the numbers, I saw something remarkable. The company had more cash on its balance sheet than its entire market capitalization. It had no debt. It was generating consistent free cash flow, and it was trading at less than 5 times earnings. The market was essentially saying that this profitable, cash-rich business was worth less than nothing. I bought as much as I could. Over the next 3 years, the stock more than quadrupled. Not because the company did anything spectacular. It just kept doing what it had always done, generating cash and paying dividends. The market eventually recognized that it had overreacted, and the stock price caught up to reality. This is what happens with value stocks during and after crashes. The market overreacts on the downside, creating opportunities for patient investors. And because you bought cheap, you don't need heroic assumptions about future growth to make money. You just need the company to keep operating and the market to eventually recognize its value. The fourth component of a crash-proof portfolio is what I call asymmetric hedges. These are positions designed to increase dramatically in value during market crashes, offsetting losses in the rest of the portfolio. The classic example is put options on major stock indices. A put option gives you the right to sell the index at a specific price. If the market crashes below that price, your put option becomes extremely valuable. You might spend 2 or 3% of your portfolio on these options each year. And most years they'll expire worthless. But in the year when the crash happens, they might increase 10 or 20 times in value, more than offsetting your losses elsewhere. This is exactly the strategy I used in 2008 with the housing market. I paid premiums for years waiting for the crash. When it finally happened, those positions exploded in value. The money I made on those hedges was life-changing. It more than compensated for all the years of paying premiums. All the criticism I endured, all the doubt I faced, but here is what is really important to understand. The hedges didn't just make me money. They gave me the psychological freedom to hold my other positions. When you know that you have protection in place, you can think more clearly. You are not panicking. You are not selling at the bottom because you are terrified. You are executing your plan calmly and rationally. I've talked to so many investors who had the right analysis during crashes but couldn't act on it because they were too emotionally compromised. Their portfolios were down 50% and they couldn't think straight. They knew intellectually that they should be buying, but they were too scared. The hedges prevent that. They give you the mental clarity to make good decisions when everyone else is losing their minds. Now, implementing this strategy requires sophistication. You need to understand options pricing. You need to choose the right strike prices and expiration dates. You need to manage the positions actively. This is not something for beginners to attempt without education and careful thought. But the concept is important even if you don't implement it directly with options. The idea is to have some portion of your portfolio that zigs when everything else zags, that goes up when everything else goes down. That provides the psychological comfort to hold your other positions through the storm. For investors who don't want to mess with options, there are simpler alternatives. Long-duration treasury bonds, while risky in normal times, tend to rally sharply during financial crises as investors flee to safety and the Federal Reserve cuts rates. Certain volatility-linked products can increase in value during market stress. Even simple inverse ETFs, while not perfect, can provide some crash protection. I would allocate 5 to 10% of a crash-proof portfolio to these asymmetric hedges, enough to make a meaningful difference during a crash, but not so much that the carrying cost destroys your returns during normal times. The fifth and final component of a crash-proof portfolio is what I call anti-fragile investments. These are positions that don't just survive during periods of stress. They actually benefit from chaos and disruption. Nassim Taleb coined the term anti-fragile, and it perfectly describes what I am looking for. What kinds of investments are anti-fragile companies that restructure distressed assets? When other companies fail, these businesses acquire their assets at pennies on the dollar and turn them around for profit. The worse things get for everyone else, the better the opportunities for these specialists. Short sellers and special situation investors, funds that profit from corporate distress, fraud, and mismanagement. When the tide goes out and we see who has been swimming naked, these investors are positioned to benefit companies with counter-cyclical demand. Healthcare companies that treat conditions that increase during economic stress, discount retailers that gain customers when people are cutting back, addiction treatment centers, unfortunately, tend to see increased demand during hard times, certain commodities and commodity producers that benefit from supply disruptions. When the global supply chain breaks down, the companies that can still produce and deliver essential goods become incredibly valuable. I would allocate 10 to 15% of a crash-proof portfolio to these anti-fragile investments, enough to provide meaningful upside during crises, but diversified across multiple types of anti-fragility so that you are not dependent on any single scenario playing out. Now let me bring all of this together and show you how the components work as a system. Because the power of a crash-proof portfolio comes not from any single position, but from how the pieces interact. In a normal market environment, this portfolio won't be the top performer. The cash and gold allocations will drag on returns. The value stocks will probably underperform the growth-heavy indices. The hedges will slowly decay. You'll look at your statement and feel like you are missing out. This is the price of insurance. You are giving up some upside in exchange for protection on the downside. And for a while, maybe a long while, it will feel like you are making the wrong choice. But then the crash comes and everything changes. The cash that was earning 2% suddenly becomes the most valuable asset you own. While everyone else is watching their portfolios collapse, you have ammunition to deploy while others are forced to sell at the bottom. You are buying the value stocks hold up better than the growth stocks. Instead of falling 70% like the high-flying momentum names, they might fall 30%. And because you bought them cheap, they're still trading at reasonable valuations, even after the decline. The gold position rallies as fear grips the market. While your stock allocation is falling, your gold is rising, offsetting some of the pain. The asymmetric hedges explode in value. Those put options you've been patiently holding suddenly increase 10 or 20 times. That position that was costing you 1% per year just made you 50%. And the anti-fragile investments start generating opportunities. The distressed asset specialists are finding deals everywhere. The short sellers are printing money. The counter-cyclical businesses are seeing demand surge. When you add it all up, your crash-proof portfolio might be down 10 or 15%. When the market is down 50%, you've preserved most of your capital. You've maintained your ability to think clearly because you are not in survival mode. And you are positioned to take advantage of the opportunities that only appear during crashes. This is what I mean by surviving and thriving. Not avoiding losses entirely, that is impossible. But limiting the damage, maintaining your composure, and positioning yourself to benefit when the recovery comes. Now, I want to address some objections because I know what some of you are thinking. First objection, this portfolio will underperform in a bull market. Yes, absolutely. If the market goes up 30% next year, this portfolio will probably go up 10%. You'll feel like an idiot. Your friends who are fully invested in growth stocks will be bragging about their returns. You'll be tempted to abandon the strategy, my response. So what the goal isn't to maximize returns in every environment. The goal is to protect your capital and be positioned for long-term success. The investors who chase returns in bull markets are the same ones who get destroyed in bear markets. They give back all their gains and more. The tortoise beats the hare. Second objection. You can't time the market. So why bother preparing for a crash? This is a fundamental misunderstanding of what I am advocating. I am not saying you should try to time the market, jumping in and out based on predictions about what will happen next. That is a losing game. What I am saying is that you should always be prepared for bad outcomes. You should structure your portfolio so that you can survive whatever happens. This isn't market timing, this is risk management. The difference is crucial. Third objection, hedges are expensive and usually lose money. True, if you spend 2% of your portfolio on put options every year, and the market doesn't crash for 5 years, you've lost 10% on your hedges. That is a real cost. But consider the alternative. If you are fully invested in stocks and the market drops 50%, you've lost 50%. Which is worse, the slow bleed of hedge costs or the catastrophic loss when the crash finally happens? Insurance always feels expensive until you need it. Then it feels like the best money you ever spent. Fourth objection. I am young and have a long time horizon, so I should be aggressive. There is some truth to this. If you are in your 20s and have 40 years until retirement, you can afford to take more risk because you have time to recover from losses. But even young investors should understand the psychological impact of major losses. Studies show that investors who experience a 50% loss in their portfolio become much more risk-averse afterward. They tend to sell at the bottom and never fully recover because they're too scared to get back in. The theoretical ability to recover from losses doesn't help if the actual experience of losing causes you to abandon your strategy. A crash-proof portfolio helps you stay in the game. It prevents the catastrophic loss that might cause you to panic and make permanent mistakes. Let me share some specific warning signs that I am watching right now. These are the indicators that tell me to be particularly cautious about market risk. First, valuation levels in certain segments of the market are extremely elevated. Some popular stocks are trading at valuations that assume decades of perfect execution and continued dominance. Any disappointment will be severely punished. Second, debt levels across the economy are at historic highs. Government debt, corporate debt, consumer debt, all of it. High debt levels make the entire system more fragile and more vulnerable to shocks. Third, market concentration is extreme. A handful of giant technology companies account for an unprecedented share of the major indices. If those few companies stumble, the entire market will feel it. Fourth, complacency is rampant. Volatility measures are low, investors are fully invested. Everyone seems to believe that the Federal Reserve will always save them. This is the kind of environment that precedes major dislocations. Fifth, and this one is harder to quantify, there is a sense that traditional rules no longer apply. Deficits don't matter. Inflation is transitory. Stocks always go up. When people start believing that this time is different, it is usually a sign that it is not. None of these indicators tell you exactly when a crash will happen. The market can remain irrational for a long time, but they do tell you that the conditions for a crash are in place. And when those conditions exist, a crash-proof portfolio isn't paranoia, it is prudence. I want to close with a thought about what comes after the crash, because crashes don't last forever. Eventually, the panic subsides. Prices find a bottom. The recovery begins, and the investors who were prepared, who survived the downturn with their capital intact, are positioned to benefit enormously. This is the part that people miss when they think about crash-proof investing. They focus on the defensive aspect, on not losing money, but the real power is on the offensive side, having the resources to take advantage of once in a generation opportunities after the 2008 crash. Stocks traded at valuations not seen in decades. High-quality companies were available at prices that seemed absurd. Real estate was being sold at foreclosure auctions for pennies on the dollar. The investors who had cash and courage made fortunes. The same thing will happen after the next crash, and the crash after that. This pattern has repeated throughout financial history and will continue to repeat as long as markets exist. A crash-proof portfolio positions you to be on the winning side of that pattern, to be the buyer when everyone else is selling, to acquire assets at distressed prices that will generate returns for decades, to turn crisis into opportunity. That is the real reason to build a crash-proof portfolio. Not fear, not pessimism, but the recognition that markets are cyclical, that crashes are inevitable, and that the prepared investor can transform disaster into fortune. Build your crash. Proof portfolio now while things are calm. Have your cash ready. Own your value stocks. Hold your gold position, your hedges. Identify your anti-fragile investments, and then wait. The crash will come, it always does. And when it does, you'll be ready, not just to survive, but to thrive. That is how I would build a portfolio today. And that is how I suggest you think about protecting your wealth in an uncertain world. Because the goal isn't to predict the future. The goal is to be prepared for whatever the future brings. And right now, I believe being prepared means being ready for the worst, while hoping for the best. The investors who ignore this advice, who stay fully invested in overvalued assets with no protection, they're the ones who will be calling me crazy again. Just like they did in 2005, just like they did in 2007, and just like those times, they'll eventually realize that the crazy one was right all along. But by then, it will be too late for them. Don't let that be you. Build your crash. Proof portfolio today. Remember, the best time to prepare for a storm is before it arrives. Once the wind is howling and the rain is falling, it is too late to reinforce your house. The same is true in investing. Once the crash has started, it is too late to build your defenses. You need to have them in place before the trouble begins. I've spent my entire career studying financial markets, looking for the cracks in the system, identifying the risks that others ignore. And I can tell you that the cracks are there. The risks are real. The conditions for a major market dislocation are as favorable as I've seen in years. Maybe I am wrong. Maybe the market continues higher for another decade, without a significant correction. Maybe all my concerns prove unfounded. If so, a crash-proof portfolio will still generate reasonable returns while providing peace of mind. That is not a bad outcome. But if I am right, if the crash does come, you'll be grateful that you prepared. You'll be the one with options when everyone else is desperate. You'll be the one building wealth while others are watching theirs disappear. And you'll be the one looking back at this moment as the turning point that set you up for financial success. The choice is yours. Prepare now or regret later. I know which choice I am making,